Welcome to Lesson 5. In this lesson, I'm going to talk to you about the investment mistake of trying to beat the market. Here's a little story. It's a story of two seemingly different brothers that share a common job. Cornelius was a rather astute and precocious child. He was a hard worker, very analytical, and type A. He got a perfect score on his SAT and went on to get an MBA in finance and statistics. After graduating, Cornelius started a mutual fund where he focused on discovering, analyzing, and investing in large-cap U.S. companies. He spent hours digging through their financials and would crisscross the country, meeting with the executives of the companies he was thinking about investing in. He had detailed spreadsheets and forecasts of the companies, their competitors, and the economy. Every year, his mutual fund performance would be compared to other mutual funds and would be compared to a similar index. In his case, the index would be other large-cap U.S. stocks. His fund would be scrutinized, and he worked more and more hours to try to do better than the other mutual funds. He had a whole staff of other analysts that did the same thing he did. They would look at 100 companies and maybe select one or two to invest in. You could say Cornelius was quite active in his approach, always analyzing and studying, and buying and selling. His brother Bodai was not quite as intense. Bodai was more interested in surfing. Sure, he liked to make money, but he also liked to hang 10. Bodai saw the success of his brother, so he asked Cornelius for a job. "You must be joking," Cornelius retorted. "I would never hire you. You couldn't even get your GED." Rejected and dejected, Bodai decided to start his own mutual fund. He saw how hard his brother worked and the long hours he put in. Bodai thought, "Man, if I work like him, I'll never catch another wave in my life. That's bogus." So, he decided his mutual fund would be a little different. Instead of doing all that research, analysis, and flying all over the country trying to find the best companies, he would skip all that. Instead, at the beginning of January, he simply looked at what an index with large-cap U.S. companies had in it. All indexes will list what investments are in the index. He then bought those companies for his mutual fund. Then, the next January, he would compare what he owned versus the index. Maybe the index replaced some of their investments with others. No problem. Bodai would sell those and buy the new investments. It took him about 20 minutes every January. The rest of the year, he surfed. Now, I don't want to call Bodai lazy. You might call him passive. He wasn't trying to do all kinds of research and buy and sell throughout the year, month, or day. He just stuck with whatever investments were part of the index. Bodai wasn't trying to beat the market. He was trying to be the market. His approach was very passive. His style of investing is called passive management. He didn't do much at all. It's also referred to as index investing. Get it? Index investing. He's investing in an index. So these are two very different styles. Why is it important to know about them? It can get pretty expensive to hire all those analysts and travel all over the country. Active investment managers are usually more expensive as a result. Compare that to the passive index investing approach. Very little overhead, very few expenses. But which style is better, active or passive? In 2014, the truth is that 86% of active managers failed to beat their index. This is the big debate in the investment world. Active managers saying, we can beat the market. And then you have reality saying, no, most of you can't, and don't. As an investor, there will probably be some circumstances where you will want to have active managers, but for the bulk of your portfolio, you can't go wrong with a lazy, a passive index approach. Work with your financial advisor and put together a portfolio that is low cost, tax efficient, and that takes advantage of passive investment strategies. Coming up next, in the next lesson and final lesson, you'll learn how you can make sure you never pay too much again by following the 1-in-1 rule.